Hello, everyone. It's a nice crowd. Thank you all for coming. I'm Hein Dauven, CTO at Dusk. I'm not allowed to shield Dusk, so I'm going to do it anyway. Dusk is a layer 1 permissionless public blockchain protocol, and we focus primarily on the issuance of securities on-chain. So these problems that I'm going to talk about, specifically merging confidentiality and compliance, is one of the things I've been working on for 6 years now. And yeah, that's what my presentation will be about. But just to make you all aware, apologies if you're thinking there's going to be a tech talk, because it's going to be a history lesson. So apologies for that. I think this one is not working. So for centuries, privacy in finance was sort of a given. One of the reasons for this was mostly practical, because nobody was going to get business if all the public information from the business was going to be leaked. So privacy in finance has been there in banking for a long while. You can see here a ledger, a past ledger, like it was used in the olden days. And yeah, the bank vault, everyone knows what the bank vault is. These days everything is digital, but bank vaults were the primary way of storing financial wealth in the past. So I'm going to start with ancient banking, but before I go to banking, one of the more important things that was happening before is when we were hunter-gatherers. One of the things that was, of course, the case is people didn't trade a lot. There was no reason to really trade, right? Fast forward, when the hunter-gatherer period was over and people started making cities, people had a need to trade goods, is when finance came into play. And finance and banking are really strongly tied together, historically speaking. Currency as well. So you saw the first currencies before this time, actually, in the form of grains being traded, seeds. Later on, silver and gold became a very well-known currency to trade goods, because at some point it's not that practical to have one cow and trade it for 1.7 sheep, for example, right? It doesn't really work that well. So what happened at a certain moment in time is people started accumulating a lot of wealth. And what do you do when you have a lot of wealth? That's a risk for you, right? Like, you're not going to store a lot of bars of gold in your home and suddenly have someone come in and steal all the gold. It's also not that practical from a trading point of view. So in the ancient times, in Babylonia, so one of the first recorded periods in which this happened, people started storing wealth in palaces, in churches and temples. Those were the first centralized vaults as we know them, right? So with that came also the first loans. Now, loans as a financial tool wasn't that common, but it did happen. So it could be in the form of grain, silver, gold, and this happened not necessarily through banks. Those did come about around this time, especially at the ending period of this, but often this was done through private individuals. Now, there are some recorded instances in ancient Greece, for example, where they did have loans in place. So yeah, it's quite interesting how long we've had these concepts in place. Now, private banks held deposits of people, and they issued loans as well, and they kept account records of people, right? And these private banks were the first ones that came about around, especially I think in the Roman, ancient Rome, there you had the first private banks. Now, medieval banking, here is where things started to change a bit, and where you also get some form of cryptography, a very small one, but it came about. So record keeping was kept in-house. It was private and in-house by bankers. And bankers kept their own ledgers. Now, in these ledgers, if you leaked the ledger, you had a big problem, because in some cases it could lead to exile or even execution. In this time, we still didn't have any sort of regulation like we know it today, right? But you did have some laws that protected certain individuals that were high risk and that were doing some banking. And one of the interesting things about this as well is they started doing coded ledgers. So the person that was in the ledger was sometimes hidden. Pseudonyms were put in place, or there were some forms of very, very basic encryption. But all of this was based on trust. Everything was based on trust. Now, what you get later on is, in the 1800s, the world starts to change massively. We get the Industrial Revolution, we get urbanization, and people start to specialize more and more. And at some point, due to the specializations, people need to trade more. And this is when the banking systems as we know them come into place, right? A bit more sophisticated banking systems, and we also see the first laws coming in place, the first compliance regulations. And this is in the 1800s when you see nation states being built are the sort of prerequisite towards getting legislation in place. And then later on in the 1900s, you really see this ramp up for multiple reasons. In the case of these early banks, the reasons for doing this were a bit different from what we'll see later on, but this was mostly consumer protection, right? So protecting people that deposit funds from losing their funds. The Swiss in 1934 introduced the Swiss Banking Act, and this really codified privacy. So it was completely illegal to disclose any client information. They were the first to do this. It was already a sort of standard in the industry to do this, but they really codified it in law. They basically set the gold standard for privacy. One of the things they also allowed in the law, and which is quite illegal everywhere else, is numbered bank accounts. So what this does is basically gives you a number, and if you can prove that you're the owner of the account belonging to that number, you can access the vault. This is still done there. It's illegal everywhere else, but they still use it. And so today, here's where we got to the compliance part and how privacy starts to become an interesting meeting together. So in the 2000s, a lot changed. There were a lot of very important developments. One of the most important ones is probably 9/11. This one was really key on financial crackdowns of terrorism financing. So one of the reasons why there was a heavy crackdown on privacy is, of course, terrorism financing. And later on, when you see the 2008 financial crisis, there's more regulations for consumer protection, because a lot of the privacy that was in place in the system also led to abuse, that led to the kind of more esoteric products, financial products that came into being in the 2000s. So this is a period where you see a lot of shift. But as an answer towards this shift, and also what central banks did with issuing more funds, is you see the coming up of crypto. And crypto is very different from banking, where before you had privacy, basically a trust privacy relation with bankers. Now this moves toward technology, right? Technology that guarantees there is no trust needed in the system. But one of the problems, of course, with systems like Bitcoin and Ethereum is the transparency problem. So what you have here is, yes, you have pseudonymity, but you can see who has what funding. And this is a problem if you want to do certain activities, right? For example, if you have a business, you don't want your full ledger to be visible, right? You don't want to see every trade that's being done and how much inflow and outflow you have. So the question is, we've seen this walk through history, right? We see that there is privacy since the beginning. There is a lot of trust in place, but recently we've seen a lot of innovation going towards a decentralized setup, a system where you don't need to have trust in the system, where there are multiple people that are verifying that indeed what's happening there is legitimate, and you cannot really manipulate this easily. On the other side, you see a lot of regulatory development. So people want to break down this privacy thing, and banking has turned into a big surveillance machine. Like, it's probably the biggest surveillance machine that's out there. Banks, the amount of information they have and that they can process, it's quite astounding. They can analyze every transaction. They have thresholds in place. So can we have both? Can we have this privacy in a system and at the same time be compliant with regulations with regard to, for example, terrorist financing or whatever you have, right? Because too much privacy, regulators will reject it. They want certain information, right? They want to see that you can, that you do not overspend and where the money came from. And on the other side, too much transparency is something that institutions can't do, because for us, it's nice to know like what Warren Buffett is going to buy in 10 seconds, right? Because we can front run that information. But for him, it's not that ideal because he doesn't get the deal he wants, right? So the challenge is balancing these two. So one of the solutions we have in place at Dusk, for example, is we use zero-knowledge proofs. But we also use blockchain technology, right? We use blockchain technology for the trustlessness. So you don't need to trust the system. The money that is in the system is being verified by a decentralized group of validators. So check it. And on the other side, we use zero-knowledge proofs, which is basically a way to verify that something is true without revealing the actual underlying information. I'm not going to go too deep into the technical details. We have people here that know that a lot better than me. But we use this technology to prove that something is true without revealing those details. The data is encrypted, for example, on the blockchain, but it's publicly verifiable that it is correct. Now, we heavily use this for a security standard, but also for transfers on a network. And this is one solution to do it, right? So one of the things that we do is we have a security standard, and in the security standards, when someone trades, the trade is hidden, right? So all you say is, okay, I have a transfer going on. Am I allowed to transfer a certain given amount? It's proven off-chain and then verified on-chain, and all you see is the proof. You don't know its contents. Now, that's nice, that's fine and all, but there's still some problems here, right? Like, I can do a private transfer, but a regulator does not really know, can this person do the trade? Like, is this person known to who is doing the trades? Or auditors cannot really make reports around this because there's a lot of legislation around reporting, right? And what we build into the system is, of course, the capability to do this. So what we have specific roles where people in a group can decrypt the information, and then reports can be generated for it. But only the people that need to know can see this information. One example in our case is also on a network is because we have privacy transfers. A lot of the privacy networks that are out there that we see, like Zcash and Monero, what they do is they allow you to send money without the network seeing how much is being sent, but you don't know where it came from. And that's suboptimal, right? Like, I have to prove, if I make a transfer to a bank transfer, I have to prove, like, hey, what's the source of funds? But you cannot do that in these networks. But we built that into a system that only the participants, for example, can see what's going on. And this already is a key thing to make compliance happen, right? And the other thing is, of course, confidential smart contracts. So this technology, the zero-knowledge proofs, can be used in our contract platform. So the future of privacy in finance. We see that there is a lot of things going on in traditional finance that gets away from the privacy part. You still have privacy with other participants in the network, but there are a lot of people that can see what's going on. And on the other side, blockchain is completely transparent, except when you use more newer, more innovative solutions like the zero-knowledge proofs that we use. So GDPR and front-running challenges can be solved with this technology. GDPR, because you can have private profiles where you can prove that you're a certain person without revealing your identity on-chain. And on the other side, because the transfer of value is hidden, the front-running challenges go away, because you can still do certain front-running attacks, but you don't know what the result is, so financially it's not worth for you to do it. It's at your own risk. And of course, we have programmable compliance. So what currently happens is, If your bank is asking you, hey, where did the money come from? Or you start to onboard with a bank, they ask you, hey, are you a terrorist? Well, of course I'm not. I'm going to answer, I'm not a terrorist. Even if I might be one, right? I don't know. Maybe I'm a financial terrorist. I don't know. But with this technology, with the blockchain, you can codify these sort of rules. You can make those rules part of the system, and then they're ingrained, they are inherent in there. So if you, for example, do KYC with a trusted party, and they issue you on-chain proofs that say that you are a specific person that's KYC'd, then you can start doing on-chain activities. Then you have already codified it into a smart contract. So I think that what we are building, what we have been building for the last 6 years, and what other people are also experimenting with, is going to be the future of privacy in finance. Codifying these rules into smart contracts, into trustless systems, is going to be the future. So to me, it's not one or the other. It's a balancing act, right? And we can do both. The technology is already out there to do both. Now it's just a matter of seeing it happen in mass adoption. That's my talk. Thank you. I'm not sure if you have time for questions, but yeah, okay. I'm getting a green light, so if anyone has any questions, feel free to shoot. No one? Okay. Thank you.